The hidden cost of multiple advisors, an $86,000 mistake. About 3 weeks ago, a client walks into my office for her annual tax planning review. Let's call her Sarah. Sarah's the kind of client every advisor loves. She's a diligent saver, she asks great questions, and she takes her finances seriously. She's been working with our firm for about a year now, and we manage her qualified accounts, her IRAs, old 401k rollovers, that kind of thing. But she kept her other advisor, the one managing her taxable brokerage accounts. Her reasoning made sense on the surface. I don't want to keep all my eggs in one basket. Having two advisors keep everyone honest. I get it. I've heard that logic 100 times. It sounds smart. So we're sitting down to do our annual tax planning review. This is the routine stuff we do for each client. The goal is simple. Look at her complete tax picture, figure out if we should do any Roth conversions this year, and optimize her tax situation. I'm pulling up her information, reviewing her income, and I need to see her full picture. So I asked her to pull up the statement from her other advisor, the brokerage account she kept with firm B. She logs in, I look at the screen, and my stomach drops. Over $86,000 in realized capital gains, already booked for the year. Gains that no one told her about. Gains that just torpedoed every bit of tax planning we're about to do. I look at Sarah. She's staring at her screen, confused. Is that bad? Yeah, that's bad. That's really bad. Because what she's looking at isn't just a number on the screen, it's thousands in unexpected taxes. Thousands more in Medicare surcharges for the next 2 years, and a Roth conversion opportunity worth tens of thousands in future tax-free growth just gone. The total damage from this one coordination failure, somewhere between $35,000 and $70,000. And here's the thing, Sarah isn't unique. Nearly 1 in 3 wealthy Americans work with multiple financial advisors. Among people with over $5 million in assets, that number jumps past 50%. So if you're nodding along thinking, that's me, you're in good company, but just because it's common doesn't mean it's optimal. Today I'm walking you through exactly what happened to Sarah, why the system is structurally designed to fail when you split your advisors, and what this fragmentation is actually costing you, not just in taxes, but in lost opportunities you don't even know you're missing. So let's get into it. Why Sarah thought she was being smart. So let me back up and tell you Sarah's full story, because understanding how she got here matters. Sarah was a successful professional. Think doctor, lawyer, executive level income. She'd been accumulating wealth steadily over years. She's a smart saver, remember. Disciplined. The kind of person who doesn't make impulsive financial decisions. A few years back, she started working with 2 different advisory firms. Firm A handled her qualified money, the IRAs and old 401ks from her previous jobs. Firm B handled her taxable brokerage accounts and some of her investment real estate holdings. And when I asked her why she set it up this way, her answer made complete sense on the surface. I wanted to diversify. I don't want all my eggs in one basket. Plus, having 2 advisors means they keep each other honest. If one's underperforming or missing something, the other might catch it. Sounds familiar? Because that's exactly what most people think when they split their advisors. And I get it. Diversification is drilled into our heads as investors. Don't put all your money in one stock, one sector, one asset class. Spread it out. Manage your risk. But here's what Sarah didn't realize and what most people miss. Diversifying your investments is smart. Diversifying your advisors is something completely different. When you diversify your investments, you're spreading your risk across uncorrelated assets. That works because markets are unpredictable. Your stocks, bonds, real estate, they move somewhat independently, and that's a good thing. But your financial plan isn't like that. Your plan needs integration, not diversification. Because here's the reality. Tax laws doesn't care which advisors made those decisions. The Medicare threshold don't care that you have 2 advisors who don't talk to each other. The IRS sees one tax return, not 2 separate silos. And here's what's fascinating. You'd think more advisors would mean more confidence, right? Better outcomes. That's what Sarah thought. That's what most people think. But research from Russell Investments found the opposite. Investors with consolidated relationships report 23% higher satisfaction than those splitting assets across multiple advisors. The primary reason? Clarity and accountability versus confusion about who's actually responsible for your overall results. When something goes wrong in Sarah's situation, and you'll see something did go very wrong, who's responsible? Who fixes it? Who even knows it's broken? That's what Sarah was about to find out the moment everything unraveled. So we're back in my office. Sarah's looking at her screen, $86,000 in realized capital gains staring back at us. And I watch her process this in real time. First confusion, then the questions start. Why would they realize those gains? Did they need to for some reason? Well, maybe. Probably they had reasons. Rebalancing, portfolio repositioning, setting up for some strategy next year. On paper, looking at just that account in isolation, their move might have made sense. Did they tell me this was happening? I asked to see her recent statements and emails from Firm B. We dig through them. There's probably a line item somewhere in a quarterly statement, maybe a note buried in a performance report, but nothing that screamed, hey, we're realizing $86,000 in capital gains this year. Should I have known this was a problem? And that's the question that gets me. Because no, she shouldn't have known. That's exactly why she hired advisors in the first place. She's not a tax strategist. She's not a financial planner. She's a successful professional who hired people to manage this stuff. And that's when I have to walk her through the damage. This is the part of my job I hate, the IRMAA bomb. Sarah, have you heard of IRMAA? She hasn't, and most people haven't until it hits them. IRMAA, IRMAA, stands for Income Related Monthly Adjustment Amount. It's a Medicare surcharge for high earners, and the threshold matters a lot. For 2025, IRMAA kicks in at $106,000 of modified adjusted gross income for single filers, $212,000 for married filing jointly. Once you cross that line, your Medicare premiums jump. Standard Medicare Part B premium is $185 per month, about $2,220 annually. That's the baseline. But cross that threshold and their surcharges start piling up. The first tier adds $888 per year. The next tier adds $2,220 per year. And keep going, you're looking at $3,550, $4,882, even $5,326 in extra annual costs. And that's just Part B. Part D prescription coverage adds another $164 to over $1,000 at those same income levels. Combined, we're looking at $2,000 to $6,000 plus in additional Medicare costs per year. I can see Sarah doing the math in her head. So for 2 years? Exactly. IRMAA uses a 2-year look back. Your 2025 premiums are based on your 2023 income. One decision in 1 year impacts you for 24 months. She nods slowly, then asked the question I knew was coming. What else? The tax bill. Those capital gains? At the 15% federal long-term capital gains rate, that's $12,900 in federal taxes. I pull up her state tax bracket and another couple thousand for state. We're looking at around $15,000 in taxes on gains you didn't even know you were taking. She's quiet for a moment. Then, okay, that hurts, but we can handle it. What else aren't you telling me? Remember I told you she's a sharp client. She knows there's more. The Roth conversion we can't do. Here's the bigger problem. The whole reason we scheduled this meeting was to look at Roth conversions. Based on your income for the year, we had a window to convert maybe $50,000 from your IRA to a Roth IRA. The tax cost could have been manageable, and over the next 20 to 30 years, that $50,000 grows tax-free instead of tax-deferred. Now those $86,000 in gains just filled up your tax brackets. If we add a Roth conversion on top of that, we're pushing you into a bracket where tax cost eliminates the benefit. The conversion just doesn't make sense anymore. So we just don't do it this year, right? But here's what that costs you. Research from MIT Age Lab shows proper Roth conversion timing can add $100,000 to $500,000 in after-tax retirement wealth over your lifetime. So that's $50,000 we're not converting. And at a conservative 8% growth over time, that's tax-free growth you'll never get back. I watched Sarah process this and she's doing the math. So we're talking immediate costs, the $15,000 in taxes, plus the IRMAA surcharges over the 2 years, call it another $2,000 to $12,000. That immediate hit is $19,000 to $27,000. Plus the long-term growth, the lost Roth opportunity, $20,000 to $50,000 minimum over time. Grand total, we're looking at somewhere between $39,000 to $77,000 in total damages from this one coordination failure. Sarah sits back in her chair and she says, from one decision that I didn't even know was being made. Exactly. How did this happen? Well, here's what went wrong, I tell her. Firm B had no idea we were planning a Roth conversion. Why would they? We don't have a relationship with them. They don't call us before they make moves. And we had no idea Firm B was about to realize $86,000 in gain. Why would we? We don't manage that account. We don't get trade confirmation. So when they made their move, which might have made perfect sense for them, they created a collision with our strategy. Neither side is negligent. Neither side made a bad decision in isolation, but together, disaster. Sarah asked a question that matters. So what was I supposed to do? How could I have prevented this? That's exactly the problem. You couldn't have, because you hired advisors so you wouldn't have to know this stuff. But the system assumes you're the coordinator, that you're sophisticated enough to see how decisions in one account affect strategies in another account. But I'm not. That's why I hired you guys in the first place. Exactly why the system failed Sarah. After I finished explaining everything to Sarah, there's this long pause. Then she asks, how common is this? Am I the only person this happened to? And I have to tell her the truth. You're not even close to the only one. This happens constantly. The system is structurally designed to create exactly this kind of failure. Let me explain why. Advisors operate in silos. Each advisor optimizes for their piece of the puzzle. They see their accounts, their strategy, their objectives, but they don't see everything else. And you know what? Clients assume their advisors talk to each other. They think, I've introduced them, they know about each other, surely they're coordinating. Well, no, they're not. And here's why they don't. There's no legal relationship between the firms. There are client confidentiality concerns, and there's zero financial incentives for them to coordinate. There's potential liability if they give advice affecting other advisors' work. And they operate under different compliance and documentation standards, which means you become the coordinator. Second, the client becomes the middleman. Think about what you're actually doing. You hired advisors precisely because you don't have the expertise to manage complex financial decisions. That's the whole point. But now you're expected to be the intermediary. You're supposed to know when one advisor's decision might affect another advisor's strategy. It's like hiring two contractors to remodel your house, but expecting yourself to coordinate the electrical and the plumbing work so they don't interfere with each other. You hired them because you're not an electrician or a plumber. Now you're supposed to project manage both of them? It makes no sense. And here's the hidden cost no one talks about. Research shows the average high-income professional spends 10 to 15 hours annually on financial coordination when working with multiple advisors. Duplicate meetings, forwarding information between advisors, reconciling conflicting advice, administrative tasks, and so forth and so forth. For most doctors and lawyers listening, your billable rate is $200 to $500 per hour. That means you're missing $2,000 to $7,500 in opportunity costs every year just playing phone tag between your advisors. Your time is real valuable. This isn't free. Third, the ripple effects multiply. The coordination problem doesn't stop at Roth conversions and capital gains. It affects everything. Tax loss harvesting. There's a wash sale rule. You can't claim a tax loss if you buy a substantially identical security within 30 days before or after selling at a loss. Industry estimates suggest 15 to 25% of investors with multiple advisors have inadvertently triggered wash sales that completely negated their tax benefits. One advisor sells Microsoft at a loss to harvest the deduction. The other advisor buys Microsoft the next week because it's a good value. Boom, the IRS disallows your loss. Estate planning conflicts, beneficiary designations across different firms that contradict each other. Trust funding that isn't coordinated, required minimum distribution strategies that work against each other, and this matters more now than ever. Cerulli Associates reports that 84 trillion will transfer from older to younger generations through 2045, the largest wealth transfer in human history. And studies show 50% to 70% of wealth transfer failures occur not because of lack of assets, but because of lack of communication and coordination. Beneficiary designations errors across multiple advisors are among the most common estate planning mistakes, resulting in assets going to the wrong people or being taxed when they don't need to be. Retirement withdrawal sequencing? Well, Fidelity research shows that optimal withdrawal sequencing can extend your portfolio's longevity by 2 to 3 years. But this requires coordinating withdrawals across taxable, tax-deferred, and tax-free accounts. Taking $50,000 from your IRA versus your brokerage account could mean a $5,000 to $10,000 difference in taxes that year. Multiply that over 20 to 30 years of retirement, 6 figures in unnecessary taxes. But it's impossible to execute when different advisors control different accounts and the different account types and aren't talking to each other. Why Sarah logic made sense, but was wrong. Remember, Sarah's reasoning at the beginning, having 2 advisors keeps everyone honest. If one misses something, the other might catch it. Well, that logic sounds bulletproof, and I hear it all the time. But here's why it doesn't work in practice. There's a second opinion myth. A second opinion only works when both parties have complete information. In medicine, when you get a second opinion, what do? You send all your records to the second doctor. They see your complete medical history, all your test results, every medication you're taking, your family history, everything. That's how second opinions work. In Sarah's situation, neither advisor had the complete picture. Neither saw her full financial chart. Roth B didn't even know about our Roth conversion strategy. We didn't know about Sarah's portfolio moves. Sarah wasn't getting redundancy or oversight. She was getting fragmentation. It's like having 2 doctors who each prescribe medication without knowing what the other prescribed. The drugs might each be fine individually, but together they create dangerous interactions. You're not safer, you're at a higher risk. And then there's the fee question. Let's talk about something most people with multiple advisors never calculate: what you're actually paying in total fees. Here's the typical scenario. You have a $3 million portfolio split between 2 advisors. Each manages $1.5 million and charges 1% annually. That's $15,000 to advisor A and $15,000 to advisor B, total $30,000 per year. Now, if you consolidate it with one comprehensive advisor, the industry average for a full wealth management is 0.75 to 1.25 of total assets. So let's say 0.85% on your full $3 million. That's $25,500 annually. You just saved $4,500 per year. Plus you gained coordination that could save you another $10,000 to $20,000 annually in tax efficiencies. That's $14,500 to $24,500 in annual benefit just from consolidation, not even counting avoiding the disasters like the $86,000 capital gain surprise. Over 20 years, that's $290,000 to $490,000 just from coordination and fee efficiency. So what do you actually do if you're sitting here realizing you're in this situation? If you currently have multiple advisors, first, audit the situation. List all your advisors and what they manage. Then ask yourself, when was the last time they actually communicated? Have you ever had to explain one advisor's decision to another? Are you the one doing all the coordinating? If the answer to that last question is yes, you have a problem. Second, calculate the real costs. Total fees across all advisors, add them up, you might be shocked. Then calculate your time spent managing the coordination. Multiply your hours by your hourly rate, and then estimate missed opportunity. Vanguard's research shows that coordinated tax loss harvesting and asset location can add up to 1.1% annually in after-tax returns. Conservatively, estimate you're leaving about 0.5% on the table every year just from a lack of communication. For a $2 million portfolio, that's $10,000 annually walking out the door. Not from bad investment choices, but from a lack of coordination. Third, ask the hard questions to each advisor. How do you coordinate with my other advisors? And what information do you need from my other accounts to do your job properly? If they say they don't need other information, red flag. Ask them, can you show me examples of where coordinating with my other advisors change your recommendations? If they can't, another red flag. And fourth, seriously consider consolidation. Look for a firm that can handle comprehensive planning, or keep one primary advisor and ensure others are in supporting coordinated roles with formal communication protocols. Run the math. Total fees plus opportunity costs with your current setup versus consolidated fee plus coordination benefits. If you're choosing your first advisor, if you're starting fresh, you're in a better position. Look for a comprehensive capability from the start. Can they handle investment management and tax planning and estate coordination? Do they have a team with different specialists under one roof? Ask about their coordination process. How do they work with CPAs, attorneys, and other professionals in my life? And give me an example of when tax planning changed your investment recommendation. If they can't answer that clearly, keep looking. Understand their planning process. Is it truly holistic or just investment focused with planning on the side? How often do they review your complete situation? Do they proactively look for Roth conversion opportunities, or do they have to ask? These questions matter more than investment performance. So let me bring this back to Sarah. After we finished the meeting that day, Sarah sat there for a minute. Then she said something I will never forget. I thought I was being smart. I thought I was being careful. I wasn't trying to cut corners or avoid paying for advice. I literally thought having two advisors was more responsible than having one. I thought it was the more responsible thing to do. And she was right to think that, because on the surface, it makes complete sense. The logic is sound, but the execution, the system can't deliver on that logic, because financial planning isn't like portfolio diversification. Your plan needs integration, not separation. Sarah's $86,000 surprise cost her $39,000 to $77,000 in immediate taxes, Medicare surcharges, and the lost Roth conversion opportunity. But it cost her something more fundamental: the confidence that her financial life was actually optimized, that someone was looking at the complete picture, that her hard-earned wealth was being strategically managed, not accidentally. She did everything right on paper. She hired two professionals. She was engaged with her finances. She asked good questions. She showed up for planning meetings, but the system failed her. Not because anyone did anything wrong, because no one saw everything. You wouldn't hire two different architecture firms to design different floors on your house and expect it to function as one cohesive home. You need one unified plan, not the competing visions. Your financial life is too complex, the tax code too punishing, and the opportunities too valuable for fragmented advice. According to Cerulli Associates, the average high net worth individual with multiple advisors manages 2.8 different advisor relationships. That's not diversification, that's a coordination crisis waiting to happen. And maybe you're sitting here thinking, okay, but I had multiple advisors for years and nothing like this happened to me. Great. Genuinely, that's great. But here's my question. How would you know if it had? Sarah didn't know about the $86,000 in gains until we found them during our tax planning review. How many smaller versions of that are bleeding away in the gaps between your advisors right now? You probably don't even know, because neither do they. The goal isn't just to avoid mistakes, it's to capture opportunities. Integrated planning isn't about protection, it's about optimization. And you can't optimize what you can't see completely. Sarah's story isn't unique, it's predictable. It's what happens when the system is designed for fragmentation instead for integration. So here's the question. Are you Sarah? Are you operating under the same logic she was, thinking you're being careful when you're actually creating the conditions for expensive collisions? If this resonated with you, do me a favor. Hit that subscribe button. Drop a comment and let me know. Are you working with multiple advisors right now? Have you experienced coordination failures? I love to hear your story. And if you're Sarah, if you're sitting there realizing this is you, it's not too late. You can fix this, but you have to recognize the problem first. Stay informed, stay empowered, and stay successful. I'll see you in the next one.